is not happened this quarter. Would you call that due to labor issues and capacity commissioning, or how should we look at that?
I think the revenue base last quarter was about 800 crores. This was about 740. We do expect consistent quarter-on-quarter, just previous quarter last year, this year, that we are certain of committing. From a Q4 to Q1, typically Q4 tends to be our best quarter. So you are right. I think our expectation internally was that we'd be higher than that. And because of these execution issues, we lost a fair amount of revenue and a fair amount of profitability. It's not very far off from our peak last year from Q4, but we have done the repair work internally, and while we have grown profitability well in this quarter, our internal targets are far more stringent, and I think you are right. In Q2, Q3, Q4, you can look forward to profit increases, and certainly in Q4 we will be at a substantially better profit picture than Q4 last year. I guess that follows from a quarter-on-quarter growth. But yes, you are right. We are not happy with our performance in this quarter.
Got it, sir. And sir, in this WIP, when will that going to commission, and when will the benefit start accruing to us, sir?
Could you say that again, sir?
The work in progress, capital work in progress, how that capacity will going to come for us?
It will come online this year. In the next quarter, you will see those. You will see those numbers the plants get commissioned and get built up all the way to full capacity.
So we can expect benefit in the second half?
Yes, sir.
Got it, sir. Thank you and all the best.
Thank you. Our next question is from the line of Venkatesh from Organic Capital. Please go ahead.
Compliment for excellent execution on the spoken part. I have a couple of questions. One, on the US subsidiary, what have been our broad learnings? Because it's after all a new territory, we've been there about 18 to 24 months. While we have grown, we would have probably had a lot of challenges. How are we kind of equipping ourselves to address the large market there?
I think the US, as you mentioned, the markets we're present in are all massive. The PV metal buildings market in the US is in excess of $8 billion. So even a moderate market share gets us to a revenue potential which is larger than the current size of the entire company. So that's a good thing we like to see from a market perspective. However, large addressable markets doesn't automatically become high revenue or large revenue. And to do that, I think our learnings over the last few years has been the US is a very relationship dependent market, much more so than in India. It is less cost conscious. It is far more reliability, dependability and execution oriented. So we have expanded our business development base, our engineering base, where we treat it not as a subsidiary of ourselves, but as a discrete business by itself, and ensure that our market share gains there come not just from an order book increase, but from a very good execution outflow. And quality is extremely important. The same product we make here was what we make there. In the US, it's much higher quality. I struggle sometimes to explain internally why that is also, but whatever it is, the work ethic there is much higher. It's important for us to take into account that quality has to be top-notch, delivery has to be top-notch, what we say we have to do. So imbibing these qualities has been the biggest learnings for us. Not that we didn't have them before that, but it's important for us to prioritize those in our growth journey. And it's not just a question of getting larger and larger order backlogs, which we are doing anyway. We also need to execute well, and which means good operating teams, good org structure. And we are focusing hard on building a proper team there. I mean, we now have over 220 employees in the US, and I know that we will continue to grow from strength to strength in that geography.
Nice to hear that. On body in white, we haven't heard you mention this in the last one or two calls. How are we positioned there? What is our focus on that?
So body in white, while we have had a good amount of growth and we have stabilized it and Stellantis continues to be a customer, we've added a few new customers in the past. We've received Tyvolt. We are working with, we're trying to get Kia and Hyundai as customers as well, and there will be RFQs going out. So we will add more customers, and already there will be no more customers that have been added. Product development is taking place. Over the next year or so, this is a slower growth business, I think, but it's also in a sense good in the sense that revenues don't suddenly drop in that business because there's protections in place for that. So it will be a slow growth journey, but a growth journey all the same. But that's where we are at right now. So in BIW this year, we'll see substantial growth compared to last year as well.
Understood. At a broader level, Aditya, we are at something like about 140 odd crores of cash flow. You would probably aim to maybe about triple that in about 4 or 5 years' time. That would still amount to the same numbers that you're kind of projecting, which is about 5-6% PAT kind of margin, and just about $1 billion kind of company. So is that a broad expectation?
I can speak to, rather than give that as a guidance, what I can tell you is what we are looking at and what is possible. Maybe that's a better way to answer the question.
Indeed.
So if we look at a company in the field that we are in with a similar positioning as us, if they are looking to grow in these business units, and each of these business units have addressable markets and which are that size, so you do have the expectation of your revenue more than doubling in the time frame that you mentioned, in the 3 to 4 to 5 year time period. And if your operating margins move up in the level that they should, considering market margins and that, it is very possible for us to imagine a company which is substantially larger than Pennar's size, more than twice our size. And the impact on our cash generation when you have net margins moving from 5 to, let's say, closer to 10, would be not a doubling of cash, but the doubling of revenue and doubling of that would mean at least a 4x return on a cash point of view. So that is what is the possibility. We have to execute well. By no means am I saying that's our guidance. What I'm saying is that's the possibility on the table right now in 3 to 4 years.
Understood. Okay. Thanks a lot, and congratulations on really walking the path. Thanks.
Thank you. Our next question is from the line of Vikas Puri from an individual investor. Please go ahead.
Am I audible, sir?
Yes, sir.
So congratulations on great set of numbers. Well, our company lot of depend on USA, and we are observing that they are following anti-tariff policies. How did that impact our sales growth or revenue growth there, sir? Or is it doesn't impact at all?
I apologize. Could you, your voice was a little muffled. You said what policies, sir? Sorry, anti?
So US is following tariff policy, anti-tariff policies. Like we are making India, they are now doing Make in America, like those things. How did that policy impact our sales there, sir?
I'm afraid that your voice is very muffled. I was not able to make out exactly what you're saying. But let's try again. Could you say, you said in the US, anti-what policy, sir?
Am I audible now?
Sir, I request you to use handsets while speaking.
So now I am audible?
Yes, sir, loud.
Yes, please go ahead.
Sir, I am saying that the USA is following anti-tariff policies. They are putting more and more tariffs whenever there is import there. So how does that impact our company? Because we have a lot of dependency on USA in sales and in profit, high margin business. Or is it doesn't affect at all?
So I understand. Let me answer that. So our US business, so to speak, is majority dominated by, well over 80%. We manufacture in the US and we stamp drawings, engineering work in the US, though the detailing work may happen in India. These are present in the US. So it's considered US work. So tariffs, duties don't apply at all. There are some verticals such as a hydraulics business where we do centralized production in India, and we don't intend to change that. We're also an importer of record in the US. So we have mapped out the tariff businesses, and any business where there can be a high tariff impact, we have exited those businesses already. So tariffs is not something that will apply to us at all, because we manufacture locally, we design locally, we supply locally, and the products we tend to ship there, which are higher value added. For example, hydraulics, there are no tariffs, so or very low levels of tariffs, and it would not be practical for. So tariffs over the US are typically on commodities, on less margin, value added margin products. So we do not have, because of this and us being an importer of record also in the US, IOR certified, we don't anticipate an issue because of this.
Okay, sir. Another question is that you are aspiring to be $1 billion company, and by 2030, I think you are guiding. Is it right, sir?
So as I said, sir, we will not be giving guidance in that sense, but what I can tell you is addressable market times your market share is our revenue. So our goal is, our addressable markets are all massive. Markets don't need to grow for us to be able to grow. Our market share is low. As we create more good quality assets, as we improve our operating efficiencies, we are also completely revamping our entire business process mapping here. We are working with a good team in order to make sure that we optimize what we're already doing. The combination of all of this means that our market share will grow. I have a high degree of confidence on that. So we're not curtailed by anything in the market. There's no top limit to what we can achieve. So yeah, I'm confident of continued sustainable growth at Pennar is something we are very confident of.
Thank you, sir. Thank you, sir. Congratulations again, sir.
Thank you. Our next question is from the line of Dilip Kumar, an individual investor. Please go ahead.
Yeah, hi. Aditya, the question is more on qualitative side of the business. You talked about operational issues, execution issues, and internal issues, and it looks like you are not very, happy with the current quarter number. But as an outsider, the number looks quite reasonable to me. So I just want to understand what exactly you are seeing, which is something I'm not able to see. Can you just elaborate on these issues that you are facing in terms of execution?
Let me broadly give an idea of why. I mean, yes, the numbers obviously are good, and I'm not denying that. But what I wanted to submit is that internally, since the quarter's already gone, we can talk about it with a lot more clarity. And we expected much better numbers, and much better numbers are possible. See, there's external factors and internal factors. We should never allow internal factors to not allow us to grow and scale, in my view. So even though with a large order book, for example, we had the potential to do a lot better. So we understood that what needs to happen for us to improve, to create the foundation for future growth as well, we need to have more robustness in our systems. So I think, let me give you examples of what we will work on to address this. So we will be completely revamping our business processes to get towards revenue, profit, and capital efficiency growth. We have good systems already in place, SAP, but I think they're going to be, over the next couple of quarters, changing that completely. So business processes get realigned, and internal automation gets brought in a lot of areas where things get jammed up. I think that by itself can add a lot of value to us. Other issues such as proper procurement, proper execution, labor supply being allocated properly, all of these are issues which we as a company at our level of maturity should not face. So it was more on that issue where we are internally not happy with what we have delivered in the quarter. Numbers may look good, or may look all right, but our job is not all right. Our job is to make sure that we perform up to industry market standards, and I think that's what we're going to achieve in Q2, Q3, Q4 for the rest of the year. We're confident of delivering growth, revenue and profit, and we have no issues from an order backlog customer point of view. It's not market forces that are preventing us from growing. So we will make sure we get growth in quickly. It's more from that perspective, not that there's anything.
Yeah. Understood. The second question is a little bit of confusion on this so-called low margin business. I thought that we had around 14-15% of low margin business, and to start with, Now, you are saying it's 35%. At the current level, it's around 1,100 crores of the consolidated number. Obviously, it lies in India, which means half of our India business of 2,400 crores is a business you don't, want anymore. So where does this 1,100 crores business lie? And even if you water down by 300, 250 crores, it's like 3 years for us to water down this business to zero. So can you just give me some elaboration on what exactly is low margin business and where it is lying?
So typically, a low margin businesses are businesses where the two things, let me call them low margin and lack of scalability, right? So these are businesses that Pennar has been present in from a legacy standpoint, which we we don't see a growth path to high levels of growth and high levels of PBT. So let me give an example, of our CR business. We are a cold rolling business as well. Special grade, obviously, not commodity cold roll, but special grade. These are manganese chromium alloys, 16 mm CR5, vanadium chromium alloys. So this, while the product is good, the problem here is in order to hit the higher margins, the 5, 6, 7, 10% PBT margins, you need to have scale. And you have JSW and Tata's and ArcelorMittal's all with 20 million tons per annum, 30 million tons per annum. So we will be unable to scale that business. So we would want to gradually reduce the dependence. So the percentage basis, the revenue attribution wise, as the company growth comes down, but also just gradually exit those verticals. Because going into them and scaling those verticals means that they become a commodity player, and that is not what we want to do. Similarly for railways itself, there's fabricated components we make for them, end walls, side walls, roof assemblies. Now that is not a business, that is a business that has become very competitive. At one point of time it was okay, not that competitive, but the problem is that there's no product development in there that's owned by, ICF, MCF. So any business which doesn't have this engineering and product development angle or a continuous margin and revenue scaling potential, our businesses won't exist. We call these low margin businesses, but you can accurately call them low margin, low scale businesses. So yes, that as you said, as you noticed, 35% of the business of the company's business being in those lines does mean that that on about 350 crores, more than about 400-500 crores is that business. But I'm quite confident that it won't take 3 years for us to liquidate that fully. I think closer to about a 2-year time frame. Either we will liquidate them or we'll absorb them into the other BUs and make sure that some of them can generate some scale. But the revenue drop from those businesses preventing us from seeing higher levels of revenue growth overall, that problem goes away. That's what I would like to say that.
When you meant 35%, you meant 35% of the domestic business.
Could you say that again, please?
I'm just asking for a clarification.
Hello?
When you said 35, you're just asking for a clarification. I can come in a queue otherwise. The two questions.
I think this is an important question. So if the moderator, if it's okay, can we just take this question? Because my apologies.
Clarification, I wanted. So when you said 35%, you are essentially meaning 35% of domestic business, which is 2,400 crores. Is that correct?
No, that's not correct. It's 35% of our overall revenue base. So the math you did, which says that on a domestic basis it will be higher than 35%, is accurate. It's correct.
Okay, fine. Okay, understood. Thank you very much.
But it won't take us 3 years, sir. That's not. Every quarter there's improvement. Every quarter there's.
The size and the reason I'm a bit concerned is that 5 years back we thought alloy steel tube is the business to be in. We invested a lot, I think 50-60 crores in setting up capacity. And after 5 years, if you are saying that it's not a business we desire, it's a little bit of concern as an investor. How is our process of, how do we know that today what we think is good business will become after 4 years bad business? That's my only concern, Aditya.
That's good, but just to correct you, sir, tubes is a growth vertical for us. Tubes isn't considered a low margin or a low scale business. Primarily CDW, DOM is our product there, and the operating margins there are above. And we are actually investing capital, as I mentioned to a previous question. We are investing capital into our large diameter tube business. as I had mentioned, that the CapEx will primarily this year go into hydraulics and our tubing business. So, no, there's not. I would agree that would be a viable concern, but that's not what's happening. We are growing our tools business.
Okay. Yeah. Okay. All the best, Aditya.
Thank you. Thanks so much.
Thank you. Ladies and gentlemen, please limit your question to 2 per participant. Should have a follow-up question, we request you to rejoin the queue. Our next question is from the line of Sai Ganesh from Square 64 Capital Advisors. Please go ahead.
Thank you for the opportunity, sir. I just want to get the idea about what was the contribution of our total percentage of sales from the low margin business of FY23 and FY24.
Could you say that again, please? You said contribution
of low margin business for the year of FY24 and FY23.
Yeah. So FY24, which is March 2024, what we are now designating a low margin, low scale business, was about 45%. But allow me to get back to you a more accurate number on that. That number is now lower.
Okay, sir. Okay, that's it from my side. Yeah, thank you.
Thank you. Our next question is from the line of Ashish Soni from Family Office. Please go ahead.
Sir, what is happening on auto and aerospace business in France? I think hear that from almost a year now.
Yes. I'm sorry, your voice is not clear. Auto segment.
The France auto and aerospace business, what is happening on that? We didn't hear from you for last 1 year almost.
Right. So as a call on the previous question that he had asked, our body in white business is doing well, it's growing. But I do want to differentiate, this is not one of the core growth businesses. It takes a long time for us to acquire businesses. So it's doing well, and we'll continue to acquire businesses and customers and grow there. And we are working to add 3 more blue chip automotive component manufacturers. Aerospace also the same story. I think we are working with Airbus right now, and that also is growing well. But these are small businesses. They are, BIW in its entirety was about 100 crores last year, and this year it may touch about 200 crores. But it takes a long time for these businesses to scale. So they're doing well, and they will continue to do well.
And you mentioned the capex this year will be on hydraulics and tubes. So is it India only or US also you are planning to do capex?
Most of our revenue in hydraulics is out of India, is export oriented.
And tubes?
Tubing is domestic and export.
So you'll do capex for tubes in US also, or how is it?
Currently no plans, but it is interesting that you say that. But currently no plans, but specifically in the large diameter segment, there is a good potential market in the US for and the cost economics work out. But right now we don't have plans.
And last question, this water treatment chemical solutions, there is a lot of focus by the government of India on this. So do you think this business can scale up? What's the thought process there?
Which business, sir? Water treatment. No, that's one of the what we call our legacy businesses. In fact, water EPC we have completely exited. We are not taking any orders. We have stopped taking orders on that also. Because of the same reason, margin and scale and no real entry barriers. So we could not, we have decided to. So, and there are companies doing very well in that business, and but we are not going to be going after that addressable market. Our current addressable markets are enough, so we'll focus on fewer markets and try to be larger scale in them rather than having several subscale businesses.
Okay, sir. Thank you.
Thanks.
Thank you. Our next question is from the line of Hari Kumar, an individual investor. Please go ahead.
Good morning, sir. Am I audible?
Yes, please.
Yeah. My only question is regarding the heating process equipment division. The sector has now turned positive, like the power generation. What are the potential for the business, sir? And are you investing in that furthermore?
Yes, sir. Our process equipment, as I mentioned, is a growth vertical. Doing well, record order books. You are right, I was in Trichy recently and an order book from the power sector has grown. We are not looking at that as the major driver of our markets in our process equipment business, sir. I think we're looking at the sectors we typically target, so cement, sugar, steel, these are where most of our products in the process equipment business are going to, and we want to increase that. Power is doing well right now, but as you yourself mentioned, and our order book in that is up, but the majority of our order book is non-power.
In this region, can we enter into green hydrogen business, sir?
We have no plans to enter the mini hydrogen business.
Thank you.
Thank you.
Thank you. Our next question is from the line of Dilip Kumar, an individual investor. Please go ahead.
Yeah, Aditya. I just wanted to know the startup cost that we have factored in last quarter in the Raebareli plant.
In what plant, sir? Sorry?
Raebareli.
Oh, Raebareli plant. You said startup cost in the CapEx, sir?
Yeah, the pre-opening cost. I think Srikanth talked about one-time cost. One is, of course, the salary has come down because of the bonus for the SN business guys. And there has been other income, that has gone up because of the startup cost in Raebareli plant. The pre-start cost.
I will request Srikanth to answer that question.
Yeah. There are two clarifications that I would like to clarify. One in terms of salary cost and one in terms of other income cost. In terms of other income costs, we predominantly include the deposits from mutual fund, interest income, and the collection of old receivables there. In terms of salary cost, predominantly there are two components to it. One is India salary cost and one is the US salary cost. In terms of India salary cost, there has been increase because of the new people we have deployed at Raebareli plant, the sales engineering that we have hired for engineering services and hydraulics. So that's the reason there is an increase in the India salary cost. But in terms of the consolidated salary cost, there is a decrease because there was a one-time bonus which was there last year, previous quarter, which is not there in the current year. I hope I have answered that.
Understood. Yeah, understood, Srikanth. Thanks. Yeah, that's all.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to the management for closing comments.
Thank you to all of you for your presence and your time and attention in the call today. We will continue to execute our plan for the rest of this financial year, and I'm grateful to all of you for your continued support. Thank you so much.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.